Yeah, I kind of wanted to just put that disclaimer out there where we don't recommend using credit cards if you don't have a budget, you have a spending problem, you plan to live beyond your means. Um, so that's kind of like that disclaimer where no matter how good the rewards are, no matter how good the cash back is, if you don't have the systems in place to be able to use a credit card responsibly, you're probably worse off using them. But we're going to kind of operate under the assumption that you're at a point where you're trying to maximize your spending, or not maximize, I guess that's probably not the right word, but optimize your spending. And that's what kind of a lot of the conversation that we'll probably have today around credit cards is kind of hinging on. I do want to start out with a couple stats because they are pretty crazy. 41.2% of Americans carry some sort of credit card debt. Households with zero or negative net worth hold an average of 10,000 in credit card debt, and the mean credit card debt in the U.S. As far as households go is approximately 5,700. So wow. There's some predatory things when it comes to credit cards, and it's very easy to get swept into that predatory kind of scene. And I think that these stats kind of show that, you know, it's super important to be responsible with credit cards, especially because of the interest rates that they have. But someone submitted, do you have anything that you want to talk about in general about credit cards, Tara?
No, but I would like to point out one of my rules of thumb is that you never use a credit card unless you have money in the bank to actually pay for that purchase that you just made. That it's Absolutely. Not, credit cards aren't to extend your money that you don't have. It's just a convenience, a convenient way to pay so that you don't have to carry around cash. But if you should be able to carry around the cash to make that purchase. And if you wouldn't be able to do that because you don't have the cash, then you shouldn't be using the credit card.
Yeah, and I will say that there is this one small thing that I want to add to that, because I don't want to discount people who don't have cash to pay for a credit card, where a lot of people are able to use a credit card to get them to their next paycheck to be able to pay off the expenses. And it's better than getting a payday loan or something like that. That obviously is a very small percentage of people, but there are situations that I could see the argument being made where it's okay to use a credit card, but that's, as a general rule of thumb, what Tara said is definitely
And I agree with you in that situation. Like, it's better than a payday loan, but like a payday loan, understand that you're spending next paycheck's money, which means when the paycheck comes, you're not going to have any money to pay your current expenses again. And so, you know, that's being in that kind of tight situation, living paycheck to paycheck, or actually that's not even living paycheck to paycheck. That's living, you know, ahead of your paycheck, is a slippery slope. And that is one of the things that we try to help people with the most, is when you get yourself in that situation, which is super easy to do. And people, you know, do it all the time. But you can get yourself out of that situation. And if you find yourself living paycheck to paycheck or ahead of your paychecks, get help, because there's definitely ways to fix that problem.
Yeah, that's a good point. And so I don't think that we need to get into like credit card 101s about like what a credit card is, how a credit card works. I think that that's kind of general knowledge, at least for what we're talking about. If someone has kind of basic 101 questions like that, you know.
Well, I do think that it's good to, are you going to go over like what the minimum payment is and the minimum payment versus the interest balance and the balance? Yeah. And all of that. Are you going to cover that?
Yeah, we can talk about that.
Because I think that actually can be really confusing to people who haven't studied it.
So I think to try to like keep that short, I think that it's important to understand like what Tara was talking about, how there's a minimum payment, and then usually there is like your balance, which was what at the end of the billing cycle, the total balance of the credit card That's what we refer to as your balance. And then the minimum payment is usually a number that the credit card company says you have to pay towards this balance. And usually it's 30, 40, 50 bucks, regardless of what your balance is. So it's important to note that there is a difference between your minimum payment and your balance. And what you don't pay on the balance is what you will be paying interest on in the following billing cycle. So pretty much if your billing cycle ends today, July 21st, and you have a balance of $500, your next billing cycle, you have until the end of your next billing cycle to pay your balance. Otherwise, it starts accruing interest.
And to note on that as soon as you get a balance that, yes, that balance is going to start accruing interest day one of the following month on that credit card. And also any new charges you put on there are going to be charged interest from day one. If you don't have a balance, if you go in, you have a brand new credit card, you go into the month fresh, when you charge it, you're not going to pay interest, and you will never ever pay interest if you always pay the balance at the end of the month by the due date. But if you don't, then every single credit card, every single purchase you make is charged interest from day one of making that purchase. So you're basically on that slippery slope of just mounting your interest payments, which is why some people never can pay off their credit card, because it's just you're not, even if you stop charging on it, it's going to take a long time because you still are being charged interest every single month on your balance.
Mm-hmm. Yeah, and so this goes back to the making sure that you have a budget, you have, or you don't have spending problems, you're not living beyond your means, and making sure that if you're going to utilize a credit card, which is a fantastic tool and we love them, making sure that you're doing it responsibly, because a couple months of interest payments is likely to wipe out any of the potential gains that you would get from cash back or sign-up bonuses, anything like that. So spending money to save money isn't really saving money. And it's that kind of concept of, it was on a great sale, so I had to get it. And it's like, well, did you really need that? And just because it was on a good sale doesn't necessarily mean you should have bought it. Obviously, there's a lot of factors that go into that, and it's going to come down to an individual case-by-case basis. But the main point being, don't spend money that you don't need to spend just to get rewards or some kind of benefit from a credit card.
And you can plan ahead for it so that when that sale comes, you have the money, allocate it to be able to do that.
There will always be more sales.
I think with rewards, one thing that is I guess good to think about is that the credit card company has to get that money from somewhere to give you the reward. And that's coming from people who are, paying this interest on interest and stuff like that. And so, yeah, you don't want to be the person who's paying for other people's rewards. Yeah,
that's a really good point, actually.
What's that saying where it's like you gotta rob Jack to pay Jill or something like that? That came up in something recently that it reminded me of credit cards too.
And just a little note, Bobby, your volume is loud. Can you turn it down just a bit? No, it's not your fault. You don't know that unless I tell you, right? Yeah. I'm telling you.
Is that better?
Yeah, much better. Thank you.
Okay.
Cool. So why don't we start with some of the questions that we had ahead of time? I see Sadie, you hopped on. So let me pull up. Do you want to go through your question and kind of?
Yeah. Thank you. I get to go first. I guess it's kind of two different questions. So I have a credit card. I have the basic Discover It, the student credit card. I think it's the same one Bobby has. And it's okay. It's a credit card. It gets the job done, but it doesn't really have any good benefits or rewards. There is cash back, and sometimes I can play that cash back game and make sure to use it at restaurants or gas or whatever the what it is for that month. But I'm considering getting a second credit card that's more focused on those rewards. And so question one, is it like, is getting a second credit card okay? What are like the risks that come along with that? And then the other half, how do I even, like, where do I go to find the right credit card for me that has the rewards and benefits that I'm looking for? Yeah.
Yeah, so I think to your first question, it's definitely a good idea. It's not a bad idea to have more than one credit card. I think the average American has 4 credit cards, is what I saw most recently. And I mean, personally, I have 2, maybe 3. I don't even know. I think I have one that I got when I was like in college and I needed a suit, so I got a Macy's credit card or something like that.
Uh-huh.
But yeah, so I would definitely say go ahead and get another credit card. As far as the rewards go, that's gonna vary depending on your spending habits. So I know that like I have an Amazon credit card because we spend a bunch of money on Amazon getting things that we would buy normally. And so like we try to strategize who pays for what depending on what credit card's going to get the most cash back. So like the Amazon credit card gets 5% back on Amazon purchases. So every time, like my Amazon card is the default one for all Amazon purchases. And then my girlfriend has an American Express Blue Preferred or something like that that gets, I want to say 5 or 6% back at grocery stores, and like 3 or something at gas stations. So whenever we go to the grocery store, she's paying with her credit card so that we can maximize those rewards. So I guess kind of to answer your question, it depends on where a lot of your spending is. So if you go to the grocery store a bunch, like you should probably look at something that's going to give you good cash back on grocery store purchases. If you spend a bunch on Amazon, same kind of thing with the Amazon card.
And
Right.
one thing that we talk about a lot also is know thyself. And if you can't keep track of things and make sure that you pay those balances at the end of every month, if you have just trouble keeping yourself organized, like it's not worth it. You're going to end up spending way more money than you're going to save. So know that. And also it does, having more than one card gives you more capacity to charge, which could get you in more in debt. So again, if you're not good at being vigilant about making sure that you have enough money for everything and that you're paying all your, and that you have a budget in place basically, then you need to be more careful about that. And, you know, maybe keeping it simpler would be better. So you really do need to be honest with yourself about what your limits are.
Yeah, and I will add that there is also value to be had with having a credit card that, like my Amazon my Amazon credit card is linked to my Chase account, which is where I do my checking. So it's really nice to be able to have all of that together. Whereas if I had a Discover card, I don't do checking or anything with Discover. So that is like kind of an added layer of annoyance. So that's something to take into consideration. But yeah, I mean, I think looking at spending habits, trying to find a trend, figuring out where you spend the most, and then looking at credit cards. If there is a credit card that you're looking at that has an annual fee, like you'll have to do the math to figure out, is this annual fee justified for the cashback rewards or whatever rewards you're getting? Because I know that a lot of credit card companies have like the standard and then the preferred, and the preferred offers you more cash back, but it also comes with an annual fee. And there's other benefits and perks that are probably included in the preferred card. So you kind of have to look at like what that threshold is. Like I have to spend, if I spend $6,000 a year at grocery stores, then the extra 2% in cash back pays for the annual fee, so it's worth it. So you got to really look at the math there and not just fall into either one, because either I don't want to pay an annual fee because it might make sense to pay the annual fee, or I don't want to pay the annual fee and you're missing out on something.
And then it's sort of tagged on to that, which I think we sort of touched on before, is it's really easy when you get those reward cards to slip into the game of using them because you feel like you've made money. And the fact is, if you spend $100, you get 2%, which is $2 back. And don't spend the other $98 to get the $2 back. Like, that's not a win on your case. But mentally, we sometimes slip into that. And I'll just give the example. For me, was not a credit card, but the Starbucks app where you can pay. And actually, I got it because there was a long line at a Starbucks that I normally was going to, and I could order ahead, and it would just be sitting there. I wouldn't have to wait in line. It was awesome. And so it was a really great app. But at some point, 3 years later, I realized, oh my God, I am purposely going to Starbucks and picking up coffee because it's fun. When if I just wait till I get to the office, I'll have coffee there and it's free. And I realized that I had slipped into that game. And the reward of the stars and all of that kind of thing made me make bad decisions, and I had to like stop myself and I even know, right? So it's super easy to get into that. So just it being cognizant that it is a game. They know it's a game. They make it a game that's rewarding, and that's how you build habits, right? Is that you get a trigger, you have an activity, and you get a reward. They make sure that those rewards are really good, so that when that trigger comes, you do that action so you get that reward. So fighting that is hard, but it's something that you should be cognizant of.
Yeah, and I think that kind of also just hammers in the point of you really need to make sure that you have a budget, because if you do have a budget, then you're going to stick to it regardless, or you should stick to it, and you're less likely to fall into that game where it's like, I'm just going to spend it because I want the rewards. If you can actually, at the end of the day, look at your budget and be like, whoa, I definitely fell into this trap. And like, I'll plug YNAB every opportunity I can, but it's nice, like a budgeting app like YNAB would help you identify that, and it would also help you identify where your spending habits are to kind of work backwards and find that credit card that matches it.
And I'll add to that with YNAB, you can make your own game with your own reward where you can see your net worth going up, or you can see that you're saving for vacation and it's getting bigger and that you're closer to that vacation. When you have something to look at and see, oh, I didn't spend $10 at Starbucks today, and I can move that money now into my vacation fund, and I'm one step closer. So it can help you build your own reward systems that get you to where you want to go instead of where the credit card company wants you to go.
And then I will add that there's another benefit that we haven't talked about yet, which is sign-up bonuses, which is a really good benefit that a lot of credit cards have, where if you spend anywhere from $500 to thousands of dollars in the first 1 to 3 months or something like that, you get a sign-up bonus of, I've seen them from 100, I think, up to 500. And that's another really easy one to fall into, where it's like, oh, I need to spend $3,000 in the next 3 months. Let me buy a new couch or a new bed frame. And so it's really easy to do that. I will say that when we were moving, in anticipation of moving, we did get a credit card because it was like, okay, we're going to have a lot of moving expenses. And that was a really good, the timing of it worked out really well because Mare had just graduated. She needed a credit card anyways. And it was like, okay, wait 2 months until we're about to move and then get the credit card, and you'll be able to easily hit that sign-up bonus. So it's a game. It's very much a game, and there are ways to win and there are ways to lose, like any game. But if you do it properly, it's pretty easy to make a few $100 a year from these credit cards.
And they do set it up to their advantage so that, like, that $3,000, they know if somebody charges $3,000 and then, a certain percentage of them are not going to pay it, and then they'll get this much interest, and that's where the bonus comes from. So don't be one of those people, be one of the people that uses it to your advantage. Bobby, you wanted to say something?
I was gonna say that reminds me of like getting free shipping, and it's like, oh, get your order $50 and it's free shipping. It's like, oh, I only need $8 more. Let me buy this $30 thing on top of it.
Yeah, that's a really good analogy, and like is exactly the same. And it's funny because I fall into that trap so much. Like I've never fallen into a trap with a credit card where it's like I need to spend more to get this cash back. Like I'm pretty good about that. But I mean, yesterday I ordered something online and it was like, you're $10 short of free shipping. And it's like, well, I mean, I might as well like buy something that's $10. Like it really only cost me $4 because the shipping is $6. And they like squeeze every little penny out of you. It's all calculated. I mean, there's people that are way smarter than us with these thousands of lines worth of spreadsheet information, and it's all done behind closed doors, and it obviously works out for a reason. Like,
and awareness is half the battle of trying to fight it, right? It's not 100%, but
and I think that one thing, the kind of different thing I guess about the free shipping is that you can often get something that you either would get anyway or you wanted to get anyway, or you'll actually get like some enjoyment out of. Rather than just spending money for the sake of spending money.
I justify it by like with that example that I just had. It's like I can buy this $10 thing for essentially $4 now because I'm not paying the $6 shipping. And I don't know.
Wow. Well,
did we answer your question, Sadie?
Yeah, I definitely, and it's just also weird timing to be looking for a credit card based on rewards because my spending habits are like much different now than they used to be. And so before I was considering looking for like better travel benefits or cash back at like restaurants because I work from coffee shops a lot of the time. And I was like, ooh, not only can I expense when I go to coffee shops, but also if I get cash back, like that would be great. But now I'm not doing that. And so like taking a look at my spending habits now and seeing what would benefit me now and then waiting a while. We'll see. But I
was going to say that there like mathematically will be a right answer, but also the math could come out to a couple dollars a year in difference. So like at the end of the day, there will be the optimal credit card, but I mean, if you're using a credit card to begin with and you're getting the cash back, like, in my opinion, that's the most important thing. It's better to do something than nothing.
Yeah, absolutely. Thank you.
Someone asked a question about like first credit cards. They're not here, but I think that we should just answer it in case someone else has or takes anything from it. And I think that this person is a college student. And they're wondering about if they should get a credit card, how they should get a credit card, what kind. And I think it's a good question because we run into so many people that graduate from college, don't have any credit built up. Like recently we just went to Mare, just bought a car, and they were like, oh, is this your first car? And she was like, yeah. Like, what's the interest rate going to look like? And he was like, well, if it's your first car, it'll probably be like 10, 15, 20%. And we were just like, whoa, like that's not right. And he was under the assumption that she had no credit because it was her first car and it was going to be something crazy high interest like that. But because she was able to get a credit card when she was in college and continue to build her credit before buying technically still her first car, like the interest rate was 1.9 or something like that. So it is super important to start your credit as soon as possible. Again, with those caveats of just because you have a credit card doesn't mean you should use it and spend money on it that you don't have. I personally don't like for people to have credit cards if they don't have some form of income. And so it's important to understand that. But as far as getting your first credit card, it's a lot of people get a credit card with their parents and they think that because it is a credit card, they're building their own credit, but oftentimes, I think for the majority of the times that I've seen someone get a credit card through their parent, it's actually just going to their parents' credit score. So it's not actually building your own. So it's important to go out on your own. Obviously, if you want the help of your parents, that's fine, but make sure it's signed up in your name. It's a whole new account. And it's oftentimes difficult to get that first credit card, especially if you're in college and you don't have a substantial income. A couple good options is go to a local branch of the bank that you have your checking account through. I know that's how I got my first credit card. Was I walked into a Chase branch and sat down with someone and was able to get one. Another option is what's called a secured credit card, where you put up a collateral of usually $500 and you spend on your credit card, and it doesn't ever draw money from that $500 unless you default on it and don't pay off the balance. So you do need to have that $500 put up as collateral. So it's something to keep in mind, but it's a great way to start building your credit, and it's a way that, pretty much everyone gets approved for them, and usually there's a $500 spending limit on it, so that, to account for that collateral that they have. But it's very low risk to a credit card company, and therefore you're very likely to be approved for something like that.
Yeah, and that I'll second that. College students should definitely have their own credit card, not be on their parents, because that can really, you need to have, it's pretty easy to get a credit card because they're not really doing it on your current credit rating, which you probably don't have one. They're doing it based on your income potential when you graduate, that you'll be able to have income. So even if you don't pay off the balance and you're racking up interests, they're okay with that, because they think that you're going to get a future income that will be able to pay that off, and they're willing to take that risk on you because they've done the math. They know that most people will go ahead and pay that, and they'll make money, and a couple of people will default, and they're willing to accept that. So getting a credit card as a college student is much easier. You may have to get a secure credit card, but most likely you will be able to get a credit card. And if you're at a university, there's probably a Chase branch, because Chase seems to have gotten on every single campus in the nation, specifically because they are targeting students. It's their market. They make money at it, which is great. But and while that can sound greedy and all of that, it's actually very helpful. And they are there, and they're providing a service for students. And there's nothing bad about that. It's not like they have excess fees or anything like that. But that is usually the easiest way to do it, and getting that. And then a lot of people I know start by, as soon as they charge, they go home and they pay, or on their app, they pay that off right away, just to make sure that they keep in control until they get sort of a rhythm going and understand how to use it. So, and that's definitely, and then when you get it, make sure that you charge at least once a month, pay off 100% at the end of the month, and you will be on your way to good credit score.
Mm-hmm.
I know people who own, like, maybe I did this actually. Like when I first got my credit card, I never used the credit card, but I would pay my bills with it. And so like, I used, maybe a couple $100s a month I would put on the credit card and pay it off. And it was never a big deal or anything like that. But it made it so I never like used it on a day-to-day basis. It was never like tempting, I guess. I just didn't really think about it. And it worked out pretty well.
Yeah, and then you're not going to get behind, and you're developing credit history, just paying your bills.
Yeah, I was going to say it's important to make sure that you're actually charging something to that credit card, because once you go a certain period of time, they will reach out to you and say, you have until X date to make a charge, or else we're going to close the account. So doing something small like that in college is awesome, because it pretty much just ensures that you're not going to run into that problem. And especially with like your first credit card, because age of credit is somewhat important to your credit score. It's, you want to make sure that first credit card, which is really what's helping your age of credit, stays open. But yeah, I mean, it's super important to roll out of college, because there's so many opportunities that credit can help you. And we don't focus a whole lot on credit score because if your day-to-day habits are good and you spend less than you make, like credit will take care of itself. But I will say that coming out of college, when you have to buy that first car or you're looking to apply to apartments, it is really nice to have done that legwork ahead of time to put yourself in a position where that's not a concern, where you don't apply to an apartment and it requires you to have a 650 credit score or whatever. And it would suck if it was just a matter of I didn't get a credit card 2 years ago and that's the only difference.
Mm-hmm.
Yeah, simple things that can make your life better.
Mm-hmm.
Getting a credit card and getting an internship while you're in college. Super important things to happen.
Yeah, I know my sister is considering getting her first credit card and she was like completely ready for it. But her on-campus job is not happening right now because of everything going on. And so she's like, okay, do I wait until I have a job to get a credit card, or do I get one and buy coffee on it once a month and that's like it, and that's fine, or do I really need to wait until I have a like income coming in, no matter how small it is, like something. And I don't know, I did not know the answer to that, but it sounds like getting one sooner versus later is the best
I would, as long as she can control her spending. And actually it's not a bad way to start learning, because controlling your spending is not, I think of it as like exercising, right? Like you don't get strong and muscular and like be able to run a marathon right away. It's something that you have to like sort of get better at and practice and keep going, and it's consistency that matters more than anything. So budgeting and keeping track of your finances and things, a lot of people think that they're just bad at it, and it's like, it's not that you're bad at it, it's that you haven't paid any attention to it. And it's not like you have to all of a sudden be balancing your budget every day or anything. It's just paying attention to it a little bit more as you go along. So something like this, as simple as this, getting a credit card and paying attention to it, and yeah, just charging one thing a month, but being consistent about that, making it manageable, something that you have a tickler on your calendar that says go to the coffee shop today and buy your coffee and pay your bill. That can help a lot in the long run.
Yeah, I think that I wouldn't, like, while I would say for her to get a credit card as soon as possible, I wouldn't feel comfortable recommending that unless she did have a budget. I see a budget kind of like a seatbelt, where like no matter how responsible you are with your spending or your driving, like you still want to have that seatbelt on because something could go wrong. And so it's important, especially when you're building those habits, like when you're learning driving, like the first thing you learn when you learn to drive, buckle your seatbelt. And like, that's how I view a budget, is like before you should be allowed to go and get a credit card where you can make potentially harmful decisions. You need to make sure that safety net is there in place so that you're at least aware of it. Because it is so easy. And I mean, I have plenty of friends who've gone down that rabbit hole where it's like, yeah, just put on the credit card and you don't think about it. And that's where that budget comes in, where you have to see it later. So yeah, I mean, I would say for her to definitely go ahead and do it, but under the caveat and like the little asterisk being, make sure that you have a budget there to support it.
Yeah, that makes sense.
Do we have any other questions or anything that
savings accounts, high yield saving account, or where should you keep your emergency fund?
Yeah, so this is something that Bobby reached out to me. He sent me an email, and then like 2 days later, a family friend reached out to me with almost the exact same question. I told Bobby and I told her this, that whenever someone asks a financial planner or any kind of personal finance question, there's always like a million more questions to ask. So it's hard to give kind of a blanket statement, but we are big fans of high yield savings accounts. We do think that especially for something like an emergency fund where you don't want to see it, at least I don't want to see it. Like, I don't want someone to associate a a large pool of money with something that they can spend, the high yield savings account is a good option, especially one that's held outside of your normal checking account. So kind of the opposite of the credit card thing that we were talking about earlier, where it's nice to have a credit card linked with the same institution as your checking account. It's, in this case, it's nice to have a savings account that's completely separated from your checking account. And the thing about high yield savings accounts right now is that there's a lot of options. Not many of them are paying very good interest rates. But that doesn't take away from the other benefits that they add to kind of your personal situation. And the biggest things that I would look at is try to get around 1% for the current environment. Make sure it's FDIC insured. It doesn't necessarily have to be a brick and mortar if that's not something that's of value to you. Like, you don't have to go to your Chase or your Fifth Third or your PNC or whatever bank it is to get a savings account there if you're totally comfortable doing it online. Most of the online only banks right now are the ones that are offering the 1% interest rates. But yeah, I mean, I think that, go ahead, green light, open a high yield savings account. You're never going to hear us say, like, don't save more money or like, don't have a new pot to put savings in.
The key is to make sure it's FDIC insured so that you get protection. I think it's is it up to 250 now?
Yeah, I think FDIC is 250.
250. And note that actually the FDIC insurance is per owner. So if you have a joint account with a significant other, it's actually 500,000. It's 250 for each of you. If you have beneficiaries associated with the account, they also get added. So if you have joint owners and 2 beneficiaries, you could get up to $1 million of insurance, which is really nice. But make sure that it does have the FDIC insurance. That's most important.
Yeah, and we've had a lot of experience with clients, and I want to say Ally Bank. And I've had a lot of friends that have used Ally and have had good experiences. Same with Discover. Same with, I think Goldman Sachs has a Marcus account, but there might be minimums on that. I'm not sure. Capital One has a good one. They're 360, I think. They're 360 savings or something like that. But yeah, I mean, that's a good option for especially something like your emergency account. I mean, we could probably talk for another hour on opportunity funds and what to do with an opportunity fund and what it even is. But yeah, big fans of separating out your emergency, especially from like your checking account. Like, it's really easy to see a large number in your checking account and be kind of like ambivalent to spending because you have that large number there. So being able to separate that is really nice.
So Stuart, can you cover how you would access money in somewhere like Ally?
Yeah, so when you set it up, you create a connection between like the Ally account and your checking account, and that's how you transfer money back and forth. Usually it takes a couple days for it to clear. I can't talk on specifics about how long it takes. I think it probably depends on each bank, and I'm sure there's some banks out there that grant instant access and things like that. But for the sake of being able to transfer money back and forth, it's pretty seamless if you do it online.
But that basically means that you do need to have a brick and mortar account. And if you need it for an emergency, note that there's going to be a delay. Somebody was telling me that apparently ACH transfers, which is what most transfers are actually done by paper. It's not electronic, which is why it takes 2 to 4 days to have that transfer, which I find freaking remarkable.
So I will say, to kind of bring this full circle, is that if you do have a credit card and there is an emergency and you know that you have an emergency fund there available, the credit card's a great option to cover you for those, quote unquote, cover you for those 2 to 3 days when the money's being transferred.
Yeah. And that's a good point, right? That's using the credit card to your advantage.
Exactly.
But the caveat on that is make sure you don't have a balance, because if you have a balance and then do a $3,000 charge, you're going to be paying interest on that $3,000 from day one, and that's going to rack up, and your emergency just became a fire that needs to be put out. So,
yeah. With the high yield savings account, I was especially motivated because I felt like my emergency fund, and I mean, this probably is true, is a significant portion of my wealth. And so like, all right, I could just sit there making 0.01% in a Chase savings account, and you know, of course there's like the risk reward balance. And I was looking at the money market stuff, and the money market rates right now are terrible. They're worse than the high yield savings. But at first I was looking at those, and it's kind of like, all right, just like they're not insured, and you know, you don't exactly know how, like, what's going to happen with it. Like they're pretty stable. So like ticks up the like risk a little bit. And back when I was looking at it, I think they were like, this was a few years ago, I think they were like 2 or 3%. So they were like, you know, pretty attractive. But now that they're like, 0.1% or something like that, it's not worth it.
The high yield savings account, I remember having the conversation with Tara probably a year ago when they were paying like 2.25%, and there was like, I think Ally was paying 2.35 or something like that. And it was just maybe like, oh my God, this is awesome. And looking back on it, it's like
just gone. But one thing about the money markets, brokerages, you have a money market in a brokerage, which is where you hold stocks and mutual funds and ETFs and things like that, like a Schwab or a Fidelity or something like that. And money markets and stock brokerage accounts are covered by SPIC, which is the stock exchange version of the FDIC. Pretty much the same deal on both of them. The caveat on the SPIC is that it's covering the dollars that you have, not loss of, you know, like if you have $100,000 of Tesla stock and it goes down to $50,000, they're not covering, you know, that change in value because the stock went down. But they do cover if you have $100,000 of Tesla and the brokerage goes out of business or bankrupt or whatever, they do cover you for that $100,000, which means that they also cover you for money markets, which don't normally fluctuate. And the key, the worry that people have about the money market is that there's the dollar standard. The one share of a money market is worth $1, and there's a concept of breaking the buck in money markets, which has only happened, I think, twice. The first time was in the 80s, and the second time was during 2006 when money market busted the buck, and then there was the start of a panic, and the Fed realized this is a problem, like this is like a run on the banks, we need to stop this. And so they then they basically prop it up. So at this point in time, except for, I have to say, we live in a crazy world where I used to say like this could never happen, and it did. So like anything can happen, but basically it's pretty hard at this point with the way that the Fed is backing up money markets for money markets to break a buck. So money markets are pretty secure. And that there's a whole lot of caveats in there, and they're not the most secure thing. And anything can happen, as we have seen in the last 4 years, and this year in particular. So there are risks associated, but there is also some safety nets in place to prevent that kind of thing from happening. So is it as safe as a bank backed by FDIC? No. But is it something to be worried about? Probably not. So that's just something to keep in mind.
I would feel comfortable if someone used a money market for their emergency fund, for the reasons that Tara just pointed out. Like it's safe. Like I have confidence that 99% of the time, 99.9% of the time, it's going to be okay. But if that's something that concerns you, like if there's even a doubt of like, oh man, this might not work out, just go with the high yield savings. Like there's no reason not to. It's accomplishing the same thing. And even when they were paying, like a year and a half ago when we were talking about this, like the rates were still comparable. between the money market and the high yield savings account.
Right.
Like they were pretty much the same. It was such a negligible difference that it wasn't enough to sway you in either direction simply for the rate.
Right.
Okay.
So.
Yeah.
Okay, thanks.
That's at least my experience with it.
Yeah. Good discussion.
Yeah, I don't have anything else to cover. I think that we went through a decent chunk. If there's any more questions, feel free to ask them. I know we're approaching the end of our.
Yeah. And I guess I'll just make the comment that, yeah, we'll probably wrap it up. It's been about 50 minutes. So this is 10 minutes earlier than the hour. But I think normally if we don't have any other questions by about halfway through, by 30 minutes in, we'll probably conclude also. So just for everybody here and anybody who's watching this afterwards, know that if you have a question, get it to us before, and even if you can't show up, we'll answer it and you can watch it in Yaffle later, or make sure that you get in the first 30 minutes so that we can hear that so that we know that you have a question. Okay, and with that, I think we are concluding our first office hours. Thanks for coming.
Yeah.
We have another one. Remind me of the date. August 4th, 6th.
It's
It's
Thursday.
August 6th.
Yeah, it's the first Thursday of every month. And so August, the first Thursday is the 6th. At 4 p.m. Pacific time and 7 p.m. Eastern time. So happy hour for the West Coasters and evening for the East Coasters. And yeah, so, and we'll cover the one coming up. We'll do similar kinds of topics every other time. We'll switch to new topics. So it'll be similar topics. If anybody listens to this and has more questions, you have another opportunity to ask more questions on these topics or on anything else that comes up. So.
Yeah, now I have some follow-up questions on my opportunity fund. So we can talk about that next time. I'll bring them.
Sounds good. Okay, I'm gonna